about. Maybe some of you participated last year, I don't know, but there's QR code if you would like to sign up. I mean, you know, you can have an opportunity to win some cash, and I'll probably just hang this on my office door so that people need it, they can find it. All right, so what we're going to do first is we're going to go over Chapter 10 graded homework, all right? So I know you had to submit, and I'm actually going to do Part 1 and Part 2 because Part 2 is due at the beginning of class. So you should, if you have it done, great, and if not, well, then I guess too bad, right? So we're going to take a look at the exercises from Part 1. We're going to go over the solutions to those. We're going to take a look then at Part 2. So again, I think that most of you should know by now how I do homework. I did grade the Part 1s because they were in there obviously earlier. So if you completed that, you got a green check mark. Didn't have to be completely accurate. And so I'll go through and do the Part 2 afterwards. So as long as you have it submitted by the due date for the time, you're fine. And now's your opportunity to check your work. So we'll go over the solutions. Also, your opportunity to ask questions. If you didn't get something right and you don't understand why you didn't, then this is a perfect opportunity to ask. And then we'll talk about the case study, as I promised, so that I can show everyone where the links are to get to, and actually just put them in their own module this semester, but where the links are to get to the financial statements for Pfizer, and we'll just kind of go over the questions so that everybody understands what's expected in terms of what I expect in terms of an answer or answers, and then that will be due on Tuesday, and I'll introduce you to Chapter 11, which will start in getting into depreciation, reviewing depreciation. Okay? Sound good? All right, well, let's take a look here. So this is page 551 of your textbook. Unless you have an ebook, it might be a different page. I'm sorry if that's the case. But exercise 10.1 was all about acquisition costs for land and building. And it says on March 1st, Belden Corp purchased land as a factory site for $60,000. An old building on the property was demolished, and construction began on a new building that was completed on December 15th. 2027. Costs incurred during this period are listed below. So we have the demo of the old building, the architect fees for the new building, legal fees for title investigation of the land, property taxes on the land for the period beginning March 1st of 2027, construction costs, and then interest on construction loan. Salvaged material resulting from the demolition of the old building were sold for $2,000, so you had to determine the amount. So let's take a look at the solution. I like to, if I can, just show you the solution that I have. Sometimes I don't like the way these are presented, and then I'll write them out on the board, but this is fine. So, and you could have listed this in any order. I don't care what order you listed the items, as long as you came up with the total cost of the land being 64 and the cost of construction, the building 517. And interestingly enough, there's that interest on the construction loan, which we just so happened to talk about on Tuesday. So when you were doing this activity, you might not have, I don't know if I can't remember if we talked about it before that or not, but you may have had to look that one up. So for the land, you've got your purchase price. The demo of the old building is a cost of the land, because remember, it fits into that general definition of any cost necessary to get the asset ready for its intended use. So tearing down the old building is getting the land ready for its intended use, right? And then title fees, and then you subtract out any proceeds from the sale of scraps or salvageable materials. So you should have came up with 64,000. And again, if you didn't, get it marked wrong, you still got credit. But now's your chance to fix it. Now you have a updated, accurate solution, right, that you may be able to use on the exam. Okay. So the building, we've just got construction costs, architect fees, interest on the loan. Property taxes for the period after acquisition are not a part of it. We talked about this the other day. I said specifically what kind of taxes? Well, sales tax. Back taxes. Remember, if you have to pay taxes that the previous owner didn't pay, right, in order to acquire the property, we call that back taxes. Those you can capitalize. But once you become the owner, anything moving forward, those are just going to go into a tax account. Okay? Any questions on that one? Any issues, concerns, problems? Okay. Number two, we're talking about equipment here, so same idea. So we have Oak Tree, purchased new equipment, made the following expenditures: purchase price $45,000, sales tax $2,200, freight $700, insurance for the first year $900, installation $1,000. And it says prepare the necessary journal entries. So maybe you made a list first. I probably would have done that. Maybe you just did the journal entry. In any event, the list, so to speak, is kind of included next to the debit to equipment. So the $45,000, the $2,200, the $700, and the $1,000. The only thing that you could not include in the cost of the equipment was the amount for the insurance. And if you debited insurance expense, it's fine. That's actually okay. We always debit prepaid insurance in class. Textbook is to debit the asset account and then expense the insurance that is expired later on. You guys remember that? How we do an adjusting entry to record insurance expired? Does that sound familiar? You can actually do the opposite though too. In real life, you can expense it and then at the end of the period put back into the asset account that which did not expire. So there are actually two approaches to recording insurance. We learned one way in class because we know enough to learn. We don't need to add too many options. In real life, you can actually do it the opposite way. So my point is, if you debited insurance expense, it's fine. But equipment should have been debited for $48,900. We talked about a loan and a down payment. So that's what that journal entry demonstrates. That you put a down payment of cash of $1,700, the rest you borrowed. And so the difference obviously is between the cost you capitalized for the equipment and the cash down payment that you made. Some of you probably need to tweak that one maybe a little bit. And then prepaid insurance in cash for $900 or insurance expense in cash for $900. Questions? If you didn't get that right, do you understand what you did wrong? How to fix it? Okay. All right, moving on. Number 3, right? So we have a lump sum purchase here. All right. Samtech Manufacturing purchased land in a building for $4 million. In addition to the purchase price, Samtech made the following expenditures in connection with the purchase of the land and building. So title insurance, legal fees, prorated property taxes for the period after acquisition, state transfer fees. There's a lot going on in this one. An independent appraisal estimated the fair values of the land and building if purchased separately at $3.3 and $1.1 million respectively. Shortly after acquisition, Samtech spent $82,000 to construct a parking lot and $40,000 for landscaping. All right, so number 1 says determine the initial valuation of each asset that was acquired. So the assets acquired are the land and the building, obviously. And then you also have the parking lot and the landscaping, which is considered what? What do you consider those? Not land. What are those? Land improvements. Okay. So initially, now this building, it's an old building, right? And so really it's just a cost of the what? Is it an old building or a new build? Or are we building a new building? No, wait, hold on a second. Okay, nope, all right. So we have separate, never mind, we have separate fair market values. All right, so what's the total cost though initially, before I even do anything else? What'd you guys get? Should have got $4,025,000 the total, okay? So the purchase price, because that single purchase price didn't separate the values, which that's the whole idea of a lump sum purchase, right? So we have the purchase price, we have title insurance, we have legal fees, and state transfer fees. And again, back to the property taxes. The easiest way to remember that is property taxes from the point that you take over as the owner moving forward, you cannot capitalize, only back taxes. Everybody good with that? All right, so that's the total cost, all right? Again, there's the note. The prorated property taxes are not included in the initial valuation. They are recorded as prepaid taxes and expensed over the related period, all right? So how do we figure out the allocation based on the relative fair values? And that's given. So they give us the fair value of the land, they give us the fair value of the building, and the nice thing about this is it worked out, we have a nice round percentage, right? And so land, it was 3.3, building was 1.1, the total fair values are 4.4, we only paid $4,025,000, so we've got to figure out how to divvy up that $4,025,000 over the land and the building when they're worth a lot more. And so we take the $3,300,000 divided by the $4,400,000, right? And we get 75%. So of the total fair value, the land represents 75% of the total. You take the $1,001,000 fair value of the building divided by the total fair value of $4,004,000, you get 25%. So the building represents 25% of the total fair value of the lump sum purchase. We then multiply those by the price that we paid, or the capitalized cost, let me put it that way, the capitalized cost, which was $4,025,000. So 75% of $4,025,000, $3,018,750. 25% then is $1,006,250. When I add these two up, I need to add back up to the capitalized cost of the asset. So if understandably so, if you did not get this part right, then you probably didn't get this part right, at least this half of it, because this is not gonna change this won't change, right? This is just the fair value percentages that I multiply by my capitalized cost. But if you got the capitalized cost incorrect, you're gonna have to fix that. Any questions on that capitalized cost up here? Does everybody understand why it's that? Again, the property taxes don't get included, they're not back taxes. For the future, right? Okay, so back here, now we have our values for, so we have land, we have buildings, and we have land improvements. So remember, why do we have a separate account for things like parking lots and lighting and landscaping, paving? Why do we do that? Why don't we just add it into the land?
Depreciation.
Yes, because land improvements can be depreciated because they have definite lives. They don't last forever, do they? They don't increase in value, right? They lose their value. Whereas land does not what? Depreciate. Yes, we can't mix them up in the same account. I can't put costs in an account, costs that depreciate, I can't put those in an account where the costs don't depreciate. So I got to separate them. All right. All right, so total land improvements, 122. What else did it ask for? What's requirement 2 say? Sorry, okay. That was requirement 1. So it didn't ask you to journalize those. Had you journalized them, let's talk about that. Let me go back here. I mean, what's my journal entry here? Anybody journalize it? I know it didn't ask. Come on, guys. I'm going to debit land for $3,018,750. I'm going to debit building for $1,006,250, and I'm going to debit land improvements for $122,000. This is just a total, right? But I'd credit cash then for the sum of those three. That's all. You got to know how to do those journal entries. Part 2 of this question says repeat requirement 1, assuming that immediately after acquisition, Samtech demolished the building. You see, that's what I was thinking initially when I started yapping. Demolition costs were $250,000. Salvage materials were sold for $6,000. In addition, Samtech spent $86,000 clearing and grading the land in preparation for the construction of the new building. So if you have that scenario instead, and they didn't ask for journal entries or anything like that, we've got a new cost of the land would be $4,355,000. So you just had to kind of recalculate that for part 2. So if you did not add in the demolition of the old building. That's a cost of the land. Again, it's under that blanket definition. Any cost necessary to prepare the land for its intended use, right? And then subtract the sale of materials, anything you can salvage. Scraps you can sell, that reduces your cost. So the total cost then, and you had the clearing and grading that got added in there as well. So you had a few additional expenses that we were able to capitalize in that second scenario. Land improvements don't change, nothing changed there. You will have to know how to do this for the first exam. We'll ask you questions about identifying which costs are capitalized and under which classification they belong. Land, buildings, land improvement, that whole sort of thing. So if you have questions, ask them. Are we good? I see some people still writing. All right, well, moving on, I guess. Number 7. So Janssen Corp. Acquired all of the outstanding common stock of Steinbeck for $11 million in cash. The book value and fair values of the assets and liabilities were the following. And so accounts receivable, land, equipment, and patents are all what kind of accounts? Assets, thank you. Accounts payable is a liability. All right, so kind of important to know that. And then it goes on to say, calculate the amount paid for goodwill, record the acquisition. So how much did you get for goodwill? Anybody want to throw it out there? $1 million. Very good. 1 million, there we have it. So we take the fair value of the consideration given, in other words, the amount of cash we're going to get, less the fair value of the identifiable net assets. So we take the fair value of the assets less the fair value of liabilities to get the net fair value of our assets of 10 million. So the difference, they paid 11 million for assets that had a net fair value of 10 million. Therefore, the difference or the extra must be assigned to goodwill for $1 million. And then the journal entry, very simply, it's a big journal entry, right? We debit all of the assets. That's why I asked you what all those were, right? They're all assets, and we credit the liability and we credit cash. So if you debit all the assets, you credit the accounts payable and you credit the cash, you could have figured out goodwill that way too, right? By forcing the journal entry to balance. I mean, there's another option for figuring out goodwill. But the key there was making sure that you knew you have to record the assets at what value? Fair value, yes, fair value. Any questions on that one? All right, so then you had to do, we continued Tuesday. We've got exercises 10-14, 10-15, and what was the other one? 27. I can't find it now. Where did it go? There it is. All right. Just getting organized here. Okay, so come on, there we go. Cedric Company recently traded in an older model of equipment for a new model. The old model's book value was $180,000, had an original cost of $400,000 less $220,000 in accumulated depreciation, and fair value was $200,000. Cedric paid $60,000 to complete the exchange. which has commercial substance, which, by the way, you have to, you want to, obviously that's a given. But I guess they're going to say that every time. So before I show you the journal entry, let's talk about some numbers, okay? First of all, someone tell me how we calculate the value of the new equipment. So equipment new, what gets included? The old fair value, which was 200,000, right? So this is fair value of old plus the cash. Again, you see by now they sometimes call that the consideration given, right? So when I give it, click there. And so the total value of that new equipment is 260, right? That's the first thing we have to do. The second thing is we have to figure out whether we have a gain or a loss. And how do we do that? Fair value of what? Old compared to the book value of old. So the fair value of the old, 200,000. The book value of the old, 180. And this is a gain because it's positive, 20, right? So, and I won't draw the T accounts, but they're helpful. So the T accounts would be for the old equipment, right? The cost was 400, accumulated depreciation was 220, because you have to remove those from the T accounts. And so your journal entry should look like this. So a debit to equipment for the new equipment for 260, a debit to accumulated depreciation to remove the accumulated depreciation associated with the old equipment, that's 220, a credit to the old equipment to remove it from the equipment account, credit to cash for 60, and then gains are like revenues, so we credit them. Gain on exchange or sale, actually it's an exchange, gain on exchange of 20. But these two things kind of help get you going initially. Questions? Again, if you didn't get it right, do you know why you didn't get it right? That's the important part. All right, exercise 15. Assume the same facts except for the fair value of the old equipment is 170. So this just changes to 170, right? So my value of my new equipment is now 230. And instead of a gain, I have a loss of 10,000, right? So we've got that journal entry there. A debit to equipment for the value of the new piece of equipment we just calculated there in part 1. Losses are like expenses, so we debit them. We've got to remove the old accumulated depreciation associated with the old equipment that we no longer have. That's why we're removing those accounts. So that's a debit for 220. The credit to the old equipment to remove it from the equipment account of 400,000, and then a credit to cash for 60. And again, you got to keep making sure debits equal credits. And again, I drew the T accounts the other day because at this point, if you're still struggling with normal balances of accounts, you need to go back and review that. That is critical. I will assume that you know those normal balances and increases and decreases and all that good stuff. So if that's still keeping you from getting these answers correct, you've got to go back and review. And I gave you plenty of information beginning of last semester. If you don't have a hold of any of that stuff, I'm happy to give you debit credit rule stuff if you need it. Questions? $27. next page. Hold on here. So we have Delaware Company incurred the following research and development costs in 2027. Salary and wages for lab research, materials used in R&D projects, purchase of equipment, fees paid to third parties for R&D, patent filing and legal costs for a developed product, salary, wages, and supplies for R&D that was performed for another company under contract. And then at the top of the next page, it goes on to say, this equipment has a 7-year life and will be used for a number of research projects. Depreciation for 2027 is $120,000. And then it goes on to ask to calculate the amount of research and development that Delaware should report in 2027. So hold on here, let me find it. There we go. All right, so, and you didn't have to do the journal entry, you just had to figure out the total, but simply stated, it would be a debit to R&D expense and a credit to cash. So you have salary and wages for the lab research, the materials, the fees paid to the third party, and then depreciation on the R&D equipment. So your total R&D expense should have been $1,040,000. And an additional explanation, it says the patent filing and legal costs are capitalized as the cost of the patent. So you debit what for the patent? You debit patent, you credit cash, right? It says the salary, wages, and supplies for R&D performed for another company are included in, let's say, inventory. You guys, that's one of the last things we talked about in class on Tuesday, because it did sound a little odd to call that inventory, but we did talk about it at the end of class. And they get expensed as either cost of goods sold when the revenue is recognized. And then it says the equipment is capitalized. What's the word capitalized mean? Bless you. Record as an asset. So in other words, equipment is debited, right? And then just the depreciation is expensed as R&D expense in the year that it is used for R&D activities. You have to know that one too. Any questions? All right. Yes.
So why is it included in inventory? That's like the other.
It's just the rule. Like when you, so that specifically, on Tuesday, we talked about the fact that when you perform R&D activities for another company, all of those costs are debited to inventory. Yeah, I know it's strange, right? Yes. That's just the rule. All right. R&D is one of those things where, like I said the other day, R&D, goodwill, that's just one of a few we could talk about where accounting treatment has changed and fluctuated over the years. So somebody else comes along and doesn't like that and complains about it. Yeah. All right, so now I want to just spend a few minutes. I'm not going to give you time to actually answer all the questions for the case. You guys can do that in your own time because I want to start chapter 11 here today. But I do want to show you, particularly for those who weren't here last semester, the Pfizer cases. So I will always give you the questions in the assignment. I'll show you that in a minute. But I also want to show you the links that I provide so that you can get to the Pfizer annual report that you need to answer the questions. So you'll notice, and I actually just kind of set it up in its own module, a little closer to the top of the list of modules so that you can find it a little easier, and give you 2 ways to kind of go find that information. So this is entirely up to you. I know I kind of encouraged people last semester to bookmark their page, so that way you don't have to keep coming back to the links if you don't want to. But these are 2 links. One is a direct link to the PDF, the annual report in PDF form, which isn't very searchable, not easily anyway. The other is a link to the Securities and Exchange Commission's filing website, where you can actually look up any annual report, but you can click around and get to things a little quicker using the SEC.gov page. So if you just click on this link, and you guys can, you want to look at it, that's fine. If not, you can just follow along. You'll notice that the annual report is 114 pages long. And, you know, I'm not real good at using PDFs. kind of find them frustrating. So, you know, you're literally trying to scroll through and find what you're looking for. I don't think they're as easily searchable as some of the other formats. But that's it, right? I mean, that's the quickest way to get to the report if you'd just rather do that, okay? Your other option is to go to the SEC filings, which I like. Again, it's up to you. And here, obviously, we're not directly on the filing for Pfizer, but this is just for any of you doing any kind of research or wanting to look up any information about any of the publicly traded companies that are registered with the SEC. You can come up here and search the SEC and Edgar, which is a database, and you can type in, you can actually spell out Pfizer if you want to. So that if you don't know what the ticker code is, then we'll spell out Pfizer. The problem with that is you kind of get a big long list and you're like, well, which one do I want? And typically the one you want is usually the first one that's listed. So that's Pfizer Inc. And you can see that PFE is the ticker symbol. And so you can search just by PFE next time if you'd like, but I'll click on that. And we have to go digging a little bit more. Now you might be saying to yourself, why is this a pain? You just click on the other one. Yeah, but you'll see in a minute here. So 10K annual reports, that's what I want. I do not make up these codes. These codes are, you know, basically they're IRS codes and they represent different kinds of filings. So we just have to live with it. You know, like your personal tax return is a 1040. You know, I don't know, like somebody just decided that was the number, and you know, there's tax codes and all kinds of good stuff like a 401k. You know, that's the tax identifier. Anyway, you can see that there are quite a few more recent reports that are available, but we're still going with 2022. So I have to click on view all 10Ks. And what I want you to notice here about this, and you kind of have to pay attention, as you're kind of going down through the filing date. Now, some of these are quarterly reports. A 10Q is a quarterly report. We don't want quarterly. Here's my first annual, so I want to look for 10K. And you can sort by 10K, by the way, if that makes you feel better. Annual report filing, and over here you can see the filing date is 2/27/2025. Over here is the reporting date, 12/31/2024. So it does take a few months, right? Almost 3 months for them to get their final reports out there. Remember did we talk about that the other day? The fact that, you know, you're not getting a final report on December 31st. So anyway, so I want 2022. So I want to look for the reporting date, 12/31/2022. So it is this 10K that I want because I'm answering questions about 2022. It doesn't really matter what year we pick, to be honest. There it is. So I'm going to go with this. And again, the reason that I like this is I can click on sections, okay? And I can jump around in here. So I can jump right to the financial statements. So I can look at the statement of income, so I don't have to scroll. And anybody remember, I'm hoping maybe, which two links there are really the only two links we really need to pay too much attention to? I just clicked on one of them. The notes to the financial statements is the other one. So the financial statements and the notes to the financial statements, right? And so I'm going to just kind of jump back over to the assignment so that we can see this together here. So Chapter 10 Pfizer case is in week 2, right? Here it is. I'm going to click on it. And as I promised, I just literally scan the document and I just pop it in here so that everybody has the same set of questions, all right? So you don't have to worry about looking that up in your book, but I highlight the questions that I want you to answer. Oh, look, all of them. How about that? So number 1 says, what amount in millions does Pfizer report for net property, plant, and equipment for the year ended December 31st, 2022? What is the largest category of property, plant, and equipment? So I go to my filing. Nope, not that one. And I'm looking at financial statements, and I want the balance sheet, right? Did I have to tell you guys that? I hope I didn't have to tell you that. And so what I'm looking for is the net amount of property, plant, and equipment. And you might have to look around a little bit, but do you see it in there? I know it's small, but you guys have decent eyes, right? Property, plant, and equipment. Here it is, right? you're literally just coming here and answering the questions. Remember, this data, these numbers are in millions, so that would read as what? It'd be, yes, some 16 billion, right? So that's the idea with these case questions. Because, you know, I can stand up here and talk about all this stuff, and if you never actually see it in real life, it's not going to make a huge, it's not going to make a lot of a difference to you. There is a question, and I trust that you guys are at the point in your academic careers where you can take initiative and figure things out on your own. I don't have to teach you everything, because that's just not possible. You guys are very resourceful. Number 4 says, what is Pfizer's fixed asset turnover ratio? And you might say, well, Dr. said I didn't even talk about that in chapter 10. No, I did not. But the ratio is in chapter 10, right? If you have a book, you can go find it, or you can just Google it, fixed asset ratio. And so what is the ratio intended to measure? That's one of my favorite questions about the ratio, because anybody can plug in a couple of numbers into a formula, right, and get an answer, but you have to be able to explain the answer to me. So that one you might have to do a little bit more digging. It's not maybe as obvious because we didn't talk about that specifically. So read the questions carefully. If you have questions about the questions, you know you can ask me, but that's how we approach the cases. And again, we started off last semester with Pfizer, and we'll continue with Pfizer this semester too. That's due on Monday. Or no, it's not. It's due on Tuesday. Questions? All right, well, head into chapter 11. Now, again, you are mid-level accounting students, so my expectations are growing. I expect more out of you, not less, more. And so as we go through some of the content, and it is review, and that doesn't mean that I think you're going to remember it all, but there is an expectation, I have an expectation, that you can go and figure some of this stuff out. I don't have to go over every little detail, and again, I don't have time for that. So, you know, I have to be very choosy about what we cover in class, because I certainly don't have time to cover it all, some of which I may go over faster than others. You guys have access to these PowerPoints. I'm not printing them out because sometimes they're pretty lengthy. What I do want you to notice too is, like, towards the end, so I don't even know. So we have a new requirement here with PowerPoints, or actually anything we upload to Canvas. It has to meet certain accessibility requirements. So if somebody has a disability and they're using like some kind of a reader, that the reader could identify what's on the PowerPoints. And so I have to go through, and not just me, but everybody, we have to go through all of our uploaded documents and make sure that they basically meet Americans with Disabilities Act accessibility stuff, okay? So I'm doing that as I go through the semester, but that means that, and I don't think this applies to anybody in here, this is for like people that may be blind, people that may be having to use some kind of device to hear better, but towards the end you're going to see like PowerPoints that you don't need to pay attention to, I guess. And so after number 64, like those are just for if you have a disability and you need the reader to read stuff to you. They're just different slides. So you can ignore those. but I have to leave them in there now. So I didn't want you wondering what in the heck all that was. So I thought I would mention it. So you might say, well, 65 slides is a lot, as it is, right? 64 slides, kind of, but I'm not obviously, not every slide warrants a 10-minute conversation. So, again, I've been pretty picky and choosy. I cannot cover everything, but we are going to review depreciation, and I will have some expectation that you guys can kind of figure some of this out on your own. We'll do homework, we'll go over the homework, that sort of thing. So what is depreciation? Well, if you kind of think about assets, and you kind of think about a timeline, or just property, plant, equipment, or any of these long-term assets that we have, we've got, and I'm just going to put this like a category, long-term assets. So that's all encompassing. That's my PPE, that's my intangibles, that's all of it, my natural resources. So we have the, I don't know what that is. We have the acquisition, right? And we just did that in chapter 10. And then what comes next is chapter 11, and we have depreciation. depreciation, generally speaking. Also, what we're going to have is, how do I want to, because we're going to talk about it in this chapter, but make sure I'm using the right term here. I'll just call them subsequent expenses. This is also going to be chapter 11. Subsequent means what? Not necessarily other, but it refers more to like a time period. After. Yeah, so subsequent means after. So these are costs, additional costs that, so I'm going to combine your two answers. These are additional costs that occur after acquisition. You know, like, maybe your parents, you know how philosophical parents can be sometimes. When you're like, you know, all excited to buy your first car, did any of you have your parents say to you, buying it is the cheapest part? It's all of the expenses that come after you buy the car. Like, it's not just the cost of the car that you're going to spend money on, right? It's the wear and tear, the maintenance, the oil changes, the new tires, right? All that kind of stuff. So it's kind of the same way with long-term assets like a building. I keep going around and I'm, you know, this needs painted, that needs painted, this needs fixed, that, you know, we need some freshening up in the building. And so these would be subsequent expenses that came after we constructed and remodeled this building. Does that make sense? Okay, and then we have disposal. And this is also chapter 11. Disposal just simply means what? Get rid of, yeah. Now, kind of in here we talked about exchanges already, right, a little bit in chapter 10. I mean, but exchanges can really also be an example of disposing of an old asset and getting a new one. You know what I mean? So it's almost like a two for, like you're acquiring and disposing at the same time when you exchange. All right. So this is kind of the timeline of long-term assets. And depreciation is where we're going to kind of focus here today. I don't know how much I'll get through, we'll see. But what does depreciation represent? Well, depreciation represents well, by definition, the process of, it's a process of allocating or distributing an asset's cost over the period that is benefited. Because eventually all assets lose their ability to provide a benefit. Everything wears out, right? Or loses its value eventually. When it loses value, when an asset loses value, it becomes an expense to us. And so depreciation is the process of recording that loss of value over the time that we're being served by the asset. Now, I think I might have written this on the board already the other day. I think I did, right? I said property, plant, equipment depreciates, right? Natural resources deplete. Did I write this down on the board the other day? Okay, good. And intangible assets get amortized. They all mean the same thing. It's just a more appropriate term for the classification of asset. But they all mean allocate the cost of something, spread over a period of time, the cost of a particular asset. Some of these methods that we're going to look at and review, you guys are familiar with already. But this is just kind of example. It says a company purchased a truck for $82,000 to deliver products to customers. The company estimates that 5 years from the acquisition date, the truck will be sold for $22,000. It is estimated then that $60,000 of the truck's purchase cost will be used up or consumed during a 5-year useful life. Well, that kind of makes sense, right? If you paid $82,000 for it, you think it's going to be worth $22,000 when you're done with it, then you personally consumed $60,000 of the truck's value. Make sense? All right, so yeah, so when we talk about disposal, I should add that in here, we can exchange and get a new asset, we can sell it, we can put it in the trash. Right? Set it out in the curb. Somebody will come by and pick it up. All right. So we have 3 characteristics for, it doesn't matter what depreciation. 3 criteria, 3 characteristics. I'll call them criteria. 3 criteria necessary for any and all calculations of depreciation. We've got service life. Now, these are listed a little differently than they were in your Accounting 101 book. And you're like, yeah, I don't remember Accounting 101. That's okay then, I guess. Maybe I shouldn't have even brought it to your attention. But yeah, so we have 3 characteristics that we basically have to kind of pay attention to. Service life, and you gotta be careful here. This is just how long it's going to serve the company that we're recording the depreciation for. It doesn't mean it's not going to be worth something to someone else later, right? I use this example all the time. If I'm somebody that likes to drive a new car every couple of years, right, then that car is only got a 2-year service life to me. Does that mean that when I go to sell it or trade it in that somebody else isn't going to want it? No. Does that mean that it's not any good anymore? No, right? So it's just how long it's going to serve me. And you can see it says, we express that in time or units of activity. And that's true. Time, like how many years, units of activity, how many, look, I wrote unity instead of units. Units of activity, like how many copies. So I'll give you a perfect example. We've got a new, it's new, it was new in the fall, a new photocopy machine. And we depreciate that, obviously. So we can depreciate it over the number of years we plan to keep it, or a better, a more accurate way of depreciating that is the number of copies that we get out of it. Because that copier could sit there for 5 years and get very little use out of it and be just practically brand new at the end of 5 years, right? If nobody ever makes any copies. But if we use it pretty hard and make hundreds of thousands of copies a year, that's going to wear out a lot faster. So the units of activity are probably a better indicator for a photocopier than the number of years we use something, right? And they give you an example. The estimated service life of a delivery truck could be expressed in terms of years or in terms of the number of miles that the company expects the truck to be driven. I'd probably use miles driven, but that's me. These are just, the service life is often less than the physical life. I already talked about that, right? I just said my car, if I like to buy a new car every 2 years, which I do not, does that mean that I keep it 2 years, but it's not any good after that? Of course not, right? Depending on how well you keep and maintain your car, you keep it for 10 years, 15 years if you want. So the service life is typically less than the physical life of an asset, though, and here are the reasons. At the rate at which technology changes and improves, take your laptops, for example. What do you think the service life of a typical computer is, laptop, computer, whatever you want to call it, for most businesses? So people want to get a new laptop. It's a little less. 3. It's usually 3. 2 to 3, right? Because as soon as you walk out the store with that laptop, there's something better, right? Kind of with cars too. Technology changes so quickly that we want the next best thing. Like, think about your phone, right? It's sold in the market that frequently demands new products, consuming a natural resource only economically feasible up to a certain point. Legal or contractual life of some intangible assets can be limiting. So they're giving us reasons why our service life is typically less than the physical life of an asset, and they're including all assets. We've got intangibles in here too. Management's policy may shorten the period of an asset's usefulness. Legal or contractual life may limit that as well. So you guys don't have to know that. I just kind of wanted to leave that in there so that we're aware of the fact that most of the time the service life is going to be less than the physical life. Then we have something called allocation base, and this is a term in Accounting 101 that I don't use. In Accounting 101, I call this the depreciable cost. And the allocation base is the cost of the asset minus the residual value or the salvage value. And so up there it says initial value of the asset at its acquisition. Initial value of the asset at its acquisition, aka cost, what we debited the account for, right? That's why this part in chapter 10, the homework we just went over today, where we were like debiting equipment because that is the starting point for my depreciation. If that number's not right, is my depreciation going to be right? No, because that's the number that I'm spreading over my service life, right? So I got to make sure that that's correct, all right? So depreciable cost is also the allocation base. In other words, it's the amount that I'm spreading over the years that I intend to use the asset. If I go back to the truck example where we paid 82 and it was going to be worth 22, and I just said, we plan to use up 60,000 of that asset, that 60,000 is what gets spread over the number of years we use it. So depreciable cost and allocation base are the same thing. But this was a Accounting 101 textbook term versus intermediate accounting. Different people, different authors. So again, the formula is essentially just the cost minus, and I put SV, this could be RV, not like, RV residual value, SV salvage value. Again, they mean the same thing. Just different terms, different word choices. It can be difficult to estimate how much something is going to be worth 3, 5, 10 years from now. And what you have to understand, these three criteria, this is an estimate, this is an estimate. Keep that in mind. And then the last thing is the depreciation method that we're going to choose. The one thing we know about estimates is they're subject to what? They are subject to change. And so you have to keep that in mind for depreciation. Depreciation, depletion, amortization. We can spend all this time doing all these depreciation calculations, and as soon as one of these criteria, number 1 or 2 changes, what do you think we have to redo all over again? The depreciation calculation. Yep. All right, so you guys will be familiar with some of these depreciation methods, also known as allocation methods. So a method should be selected, we have quite a few to choose from, that corresponds to the pattern of benefits received from the asset's use. Does anybody remember the very first method of depreciation we learned? Straight line. And what was so great about straight line? You guys remember? Super easy. Nope, not really any very basic calculation. We just spread the cost evenly. Straight line gave us an even amount, right? Always the simple or the easy way out. We take straight line. And then we did something called units of production, which we'll revisit, which was based on the usage of a piece of equipment or machinery, which makes sense. We talked about accelerated methods like the declining balance method, which we recorded more depreciation at the beginning of the asset's life. And then we're going to also talk about something called sum of the year's digits. Sum of the year's digits. So these last two are what's known as accelerated methods, where we record more depreciation at the beginning of the asset's life and less as the asset gets older. And of course there is a theory to why and all that good stuff. So I am going to I'm going to go through a couple examples here, and then we'll jump into just practicing a few on our own, see how much you remember, I guess. Find it here. All right, let's take a look here. So, oh, by the way, time-based methods, which obviously focuses on how much time has passed. And then we have activity methods that are looking at units of output or input as a measurement. All right, so again, I kind of already summarized this a little bit, but we have straight line, which we get an equal amount of depreciation every year. The accelerated methods here, declining patterns of depreciation with higher depreciation in the earlier years. And then I mentioned too specifically declining balance sum of the year's digits, which we'll do both of those. And then an activity-based depreciation method, units of production. So we'll try to hit all of these as part of review. You did not learn, at least I don't teach sum of the year's digits in Accounting 101, but we'll take a look at it here. All right, so let's start with the easy one, straight line. Beginning of the year, Hover Manufacturing Company purchased a machine for $250,000 and made the following estimates at that time. Estimated residual value is $40,000. Estimated service life 5 years. Estimated production is 140,000 units. So they expect to use it for 5 years or up to 140,000 units of output. Actual production during the 5 years of the asset's life was as follows. So year 1, 20,000 units, year 2, 32, year 3, 44, 28, and then 26. Total 150. So what do you notice right away? Okay. It lasted 5 years, okay. What else? The other observation, just with the data I just read. What else stands out to you? Something should. Okay, I didn't actually think of that, but it did. These are all observations. I'm still looking for one other thing. Ah, look, our estimated production was 140,000 units, right? And the total is 150. Right? So that's normal because at the beginning of, prior to the beginning of year 1, just trying to guess how many units I might get out of it. But if it's running well, right, it's not giving me any problems, why wouldn't I use it more during that 5-year period if I could? All right, so it says, we have the formula down here. So we take our cost, this is the formula, straight line, hopefully you guys remember this. Cost minus residual value. That is what I call the allocation base, or the depreciable cost. The numerator is the depreciable cost, the allocation base. In other words, the value that I'm spreading out over 5 years. And then we're going to divide by the estimated service life. So the cost was $250, the residual value was $40, and we divide by 5 years, so we get annual depreciation of $42,000 per year. Now, here's one thing I want you to be aware of. The difference in the estimates of production of 140,000 units versus the total number of units produced don't matter unless I'm going to use the units of production method. I'm not using that method just yet, but I have the data for it if I want to. Simply with the straight line method, we're taking the cost minus the salvage value or residual value, that's the depreciable base, the allocation base, and we're dividing by the estimated service life in years, or months if it's expressed in months, but it's that time factor we're dividing by. So annual depreciation is $42,000 per year. What's the journal entry to record annual depreciation? What do I debit and what do I credit? Okay, I debit depreciation expense, and I credit. Phew, okay. I was so glad you guys said that so fast. Right? And obviously, depending on what method I'm using, right? But that's my journal entry. In this table just kind of demonstrates the impact of the straight line. So I want you guys to pay attention. First of all, I like this too. It says depreciation rate. So the depreciation rate. At what rate are we depreciating here with this problem? Well, if I were to go back and I was a math major for a while, so this is kind of going back to my math major. Not really. This isn't like that hard. Right? If I wanted to create an expanded version of this, because I did like algebra, then it would look like this. Right? Okay. And so my numerator, 250 minus. So when I ask what's the depreciation rate, this is what I'm asking. My depreciation rate is, so theoretically, right, I could take the cost minus the residual value times the rate rather than dividing by 5. Do you agree? Because 1/5 is the rate that I'm depreciating at, and I can convert that to a percentage if I want to. So saying that the depreciation rate is 20% is the same as saying we depreciate 1/5 per year, or we divide by 5. Does that make sense? So the reason I explain that to you is so that you kind of get the gist of what's going on here in this little table, where, look, in straight line, our depreciable base does not change. I mean, if I'm using straight line, I only have to do the calculation one time because it's the same amount every year, right? I don't really need to do that every year because I know what it is, but this is my depreciable base every year for 5 years. My depreciation rate is 1/5 per year, or I can put 20% there. My depreciation expense does not change. It's the same amount each year. That's the whole point of straight line. My accumulated depreciation, though, on the other hand, right? So depreciation expense is an expense that gets closed out every year. But accumulated depreciation, what word do you see in here? Cumulative, right? What's cumulative mean? Yeah, it's the sum of everything, right? You keep adding each year. So my cumulative depreciation, every year I'm adding another $42,000 to this account, right? So after the first year, accumulated depreciation will only have $42,000 in it. End of year 2, you add another 42, so now it's 84. You add another 42 at the end of year 3, until my accumulated depreciation is $210,000. Which happens to be the same as what other number up here? Or up there? What is 240, or what is 250 minus 40? What did we say this was? This is called the allocation base or the depreciable base. So the sum, the total amount of my depreciation at the end of 5 years should be equal to my allocation base, because my book value at the end of 5 years should be equal to what? What is that equal to in the problem? The residual value. It's equal to the residual value. If I go back to the original data, didn't it say it's going to be worth $40,000 when we're done using it? So very purposefully, at the end of 5 years, on my balance sheet, right, it should look like this. And the cost of the equipment doesn't change. That's always $250, right? Less, this is my accumulated depreciation, so it's the cumulative depreciation, which is 210, so that this value on my books, this book value is equal to the residual value at the end of the asset's life. That's very intentional. The reason people make tables like this is so that you can easily journalize. Now you got all your journal entries and just kind of like a worksheet. You guys remember straight line? Okay. And there's the journal entry. Double declining balance. You guys remember this one? Yeah. Maybe. Okay, I'll go over this and we'll stop. At the beginning of year 1, Hover Manufacturing purchased the machine for $250. Same thing. Estimated residual value is 40. Estimated useful life is 5 years. Units production 140. Double, the DDB stands for double declining balance. Okay? So generally speaking, this particular accelerated method is called the declining balance method. There's more than one approach. There's the double declining balance method, where we double the rate and we depreciate based on that rate, or there's something called the 150% declining balance method. I won't teach you that one. That's just 1.5 times rather than 2 times. So we have 3 steps to the double declining balance. I don't know why hopefully nobody's packing up, we're not done. Number 1, determine the straight line rate of depreciation. I actually just showed you how to do that over there. What did I do? Not that. Break it. Look at my expanded formula. Which one of these pieces of my expanded formula represents? That's how I find my rate. Or we say 100%, because that's what 1 is, divided by n, if n is the variable that I use to represent the useful life. All right? So again, in this example, if I take 100% and I divide by 5, what do I get? I get 20%. Okay? Step 2 is to double the rate from step 1. Hence the term double declining balance. So 20% times 2 is, here's my rate. Okay, you never have to repeat steps 1 and 2 then. That stays the same. Step 3, is to take the rate from step 2 and multiply it by the beginning period book value. And that is going to give us the amount of depreciation that we'll record for the first year. So I'm going to actually just use this problem to do that. So what was the rate we calculated in step 2? I'm drawing a dollar sign, I don't do that. 40%. Okay. How do we find book value again? What's the formula for book value? You should know this like you know your first name. Cost minus accumulated depreciation. Okay, so what is the cost of this asset? Okay. What is the accumulated depreciation at the beginning of owning the asset? It's 0. Remember, we don't depreciate till the end, right? So in year 1, the book value at the beginning of the period is the same as the cost. So what's 40% of 250,000? Isn't it 100,000? So my journal entry in year 1 is for $100,000 of depreciation. Okay, I know this is up here, but I'm walking you through it so you know what the heck you're looking at. Year 2, the rate stays the same, but now I do have accumulated depreciation. What is it? It's 100,000. So now I'm taking 40% of 150,000, which is 60,000. And in year 3, I'm taking 40% times a new book value, 250 minus what? 160. Cumulative, all of the depreciation I've recorded so far. Okay, and that gives me, what is that 36? All right. You with me? Okay, now, how long are we keeping this asset? Okay. So, I'm going to leave you with a thought here. At the end of 5 years, and this is on the slide, but I'll explain it better on Monday. Not Monday. Why do I keep saying Monday? What should the total amount of depreciation be after 5 years? Thank you. It should be 210. It doesn't matter what method I use. The total amount of depreciation over all periods should add up to the depreciable base. It should be 210. Okay? You'll notice that in the PowerPoint, there's a little star or something here that, and this 14,000 is kind of in red, and that there's no depreciation in year 5. All right, we're going to talk about why that is when we come back on Tuesday, and we'll continue with our depreciation methods. And early on in Tuesday's class, we'll get to doing some practicing. So it'd be great if you could review what we covered so far between now and then. But other than that, aside from your case homework, that's all you need to do. Have a good weekend. Stay safe, depending on what's going to happen with the weather and the storm and all that good stuff. You too, Lauren. See ya. See you guys. See ya.